Hey everybody, it's Brett Lewis from BlackLabelRealty.com, and thanks again for stopping in and checking out our educational series on real estate investing. Today's topic is private loans, and I've gotten a lot of email from a bunch of people all over the country asking specifics on private loans and private lending. So I figured the best thing to do is for me to take some time and answer some of the questions that I've received. So let's get started. Let me pull it up here. First question is from Jeff in Boston, who is asking, what exactly is a private loan and how does it work? Basically, a private loan is a loan that is made to a real estate investor secured by real estate by a private individual. So Jeff, in your case, if you have some money to lend, you would lend me the money, or lend my company the money, and in return you would get a mortgage secured by the real estate or the project in question. The loans are first position mortgages, or they may be second position mortgages depending on the circumstance, and their security is a legal interest in the property via the mortgage, and that is properly recorded at the county courthouse. So just like a bank. So basically, Jeff, if you think of yourself as the bank and I am the borrower, you are lending me the money, and the transaction would go through just like a regular bank mortgage. When we address the loan to value and the security, I make it a hard and fast rule in my company anyway that I do not borrow more than 75% of the loan to value, or more than 75% of the value of the property. So the LTV, the loan to value, is 75% or less. That puts you as the lender in a good secure position, knowing that there's at least 25% equity, if not a little bit more, in the property. Should anything go wrong and you need to take back the property, at least you know that you're getting the property back well below the market value of the property. A lot of times I borrow money down at the 60%, 65% ratio, thereby giving you additional security on your investment. So Jeff, I hope that helps you. The second question I have is from Sally in New York, and Sally's asking, can you give me an example of how a private loan works using dollar figures? Well, sure, Sally. Basically, it works like this. Again, think of yourself as the bank, and keep in mind that loan to value ratio is 75% or less. But for this example, Sally, let's say 75% is the loan to value that we're operating under. And let's say I find a house that after I'm done fixing the house up, it is worth $100,000. So in this situation, you would be lending me $75,000 on that property, knowing that the property is worth $100,000. We would then have terms around that mortgage on that $75,000 you're lending me, and those terms are variable. I mean, you and I could negotiate 10% interest, or we might negotiate 12% interest on that. We might negotiate interest-only payments on a monthly basis, or we might negotiate an amortized principal and interest payment, and that loan may have a 5-year balloon, but it's amortized over 30 years. See, the point is, everything regarding the terms of the mortgage, we can negotiate that. It really comes down to whatever you and I agree to and what we're both comfortable with, and that's how I operate. Again, just keep in mind that loan to value is a crucial thing. I want to hammer that point home, that we do not go above 75%. In contrast to a lot of banks out there who will loan up to 80%, 90%. In the past, they've loaned 100% or 110% of the value. No wonder banks have problems. When things don't go right, there's no equity left in the property, and their position is not secured. Not in this instance. I want to make sure that my investors have that security, and I feel better at night knowing that as well. Next question is from Sam in North Carolina, and Sam is asking, as a lender, what documents do I receive? Well, Sam, Again, think of this real simply as you are the bank and I'm the borrower. And just like a regular bank, you will receive all the documents a bank would get. So most notably, you'll receive the mortgage, which is the legal instrument that has the terms of the money being borrowed, and more importantly, the security securing those funds. So basically, the property that I am borrowing the funds for is specified in the mortgage. And that mortgage is recorded at the county courthouse, just like a bank would have their mortgage recorded there. It becomes public record, and you would either be in first position, which the majority of these are first position mortgages, or if it's a smaller amount, let's say I'm borrowing money just for the renovation costs, you would be a second position mortgage. So Sam, I hope that helps you as far as that. Another point, you also get, you are listed as the mortgage holder on the property for the insurance policy. Sam, you would be listed as the mortgage holder. You would be listed on the insurance policy that way. And if there was an issue that required a claim on that policy, you would be protected. So Sam, just think of yourself as you're the bank and you receive the same types of documents, legal documents and everything that the bank would get. And my company takes care of all that. You don't have to worry about it. We use our attorneys, our title company. They are accustomed to doing this. They handle all the document preparation. I pay for it all as part of my closing, and you receive all the documents that you require. So, next question here is from New York City, and Bill is asking, can I use retirement funds to invest? Well, Bill, absolutely you can. You have to be careful how you do it. You have to know what you're doing, but yes, you can. You can use IRA money. You can use Roth IRAs. Basically, a lot of different qualified types of plans you can use. The thing is, though, you need to do it in the correct manner, and that's where I can help out. I have relationships and contacts with the proper companies and individuals that will help you set this up correctly. In a nutshell, what you're looking to do is to roll over your qualified money. So let's say you're dealing with a Roth IRA. Roll over the Roth IRA into what's called a self-directed IRA, a self-directed Roth IRA in your case. And once that money is in the proper account in a self-directed Roth IRA, you can then direct the account manager to invest those funds as a mortgage note for XYZ property. And basically what happens is they will wire the funds to the title agency or the closing agent, whether it's an attorney or a title company, and fund the deal just like a bank would fund the deal. The only difference is the money's coming from the self-directed IRA company. And then your payments back would be payments to the Roth IRA. So if you're using a qualified plan, it is a great way to increase the value of that plan in a tax-deferred or sometimes tax-free manner. And it sure is a great investment vehicle. So please, if you have qualified retirement funds and you're looking to invest in private loan, invest in real estate using private loans and private lending, contact me. I'll be more than happy to help you out and get you set up correctly. It's important, though. You have to follow the rules so that you don't run into any IRS issues and any tax consequences that you did not intend. So please contact me if you have any questions. And that pretty much wraps up the emails I wanted to get through on this training session. I will be talking in future sessions about other areas of private lending, and I'll get into some more detail in different topics. And until then, if you have questions, feel free to visit me at www.blacklabelrealty.com or send me an email at blewis@blacklabelrealty.com. And until then, happy investing.